Alright, cool. This is the first video for mentorship. Yeah. So before we get into it, I just want to give a thank you to you lot for choosing me to be your mentor. Yeah. I'm getting thank yous from you lot. I think I have to give the thank you. It's me that has to give the thank you to you guys because it means a lot if you're choosing me to learn how the markets operate. Yeah. Okay. So now there's no holding back. There's nothing. Everything I see, you lot are seeing. I'm gonna break it down to you lot. And one thing I want to tell you lot is submit to the time again, yeah? Because I know that it's mentorship now, but I have to teach you lot in a way that everything will piece together, yeah? I don't want you lot to just, jump at me, ask me what's an ordered block, a gap, what's SIBI, BISI, Fair Value Gap, those type of things. We're gonna get into that, don't worry, man. But there's no point in me teaching it to you guys as of now, because you won't be able to use it. There is a lot more things you lot need to know before we get into the actual crux of the entries and exits and those type of things, yeah? So the rabbit hole does go deep. So let's talk about one thing. I know everyone here is on a different level because some people have messaged me asking, is it for beginners? So let's start at the absolute beginning, yeah? Assuming you know candlesticks, so what pips are those things? I want you lot to, you can just YouTube that stuff, yeah? What's a pip? Yeah? What's a pip? Candlestick, the anatomy of a candlestick, so the open, high, low, close, yeah? Um, yeah. So let's just start with what is the market and how is price delivered? Yeah? So you see a lot of FUD on YouTube and the internet, yeah, social media. You see a lot of people say it's banks that move the market. It's not banks that move the market. I'm going to introduce you to the price delivery algorithm. Yeah, the price delivery algorithm. What is a currency? Who owns currency? Because that's what we're trading, right? We're literally just trading currencies against another currency. So who owns the currency? The central banks. Not these little HSBC, Barclays, even JP Morgan, Citibank, those type of things here. We're talking central bank. It's the central bank's, job to control the currency of their country. So, Bank of England, pound, Federal Reserve, dollar, Australian Central Bank, Australian dollar, so on, yeah. ECB, European Central Bank for the euro. They control where the price goes. Yeah. Now, there is no randomness. There is nothing. Price is delivered by an algorithm. There's no buying and there's no setting pressure. How can there be buying and setting pressure? There can't be buying and selling pressure. Why wouldn't everyone just, collectively get together and long one market? It doesn't work like that. It does not operate off of buying and selling pressure. The market seeks two things: liquidity and rebalancing inefficiencies. That's the two things. It boils down to those two things. There's nothing else. Order block, gap, those things, they're just signatures of price delivery. Okay? So what the mentorship is going to do is we're going to look at how price delivers, and essentially the entry techniques is just a signature of price delivery where price is going to deliver buy side or sell side. There are certain models that price will go into when delivering buy side and sell side liquidity. Understanding those signatures in the market lets you get in line with price delivery. Yeah? So I've already touched on in the free group the concept of liquidity. Yeah? Now, assuming that there is an algorithm at work in this market, this algorithm does the same thing every single day, day in, day out. Every hour it's delivering price. Yeah? You're telling me banks control this, yeah? How can a bank keep price in such a perfect range? Such a perfect range. Yeah? I'm not saying that banks don't have any control. They do have some small manipulation, but the main like the lion's portion of the market is controlled purely off an algorithm that operates 24 hours, 5 times a week. Yeah. So in your notes, you should have already that the algorithm, it works off of delivering liquidity buy side to sell side, and it rebalances inefficiencies within the market. That's all that it does. Now, speaking on the currency market, you have to know what are currencies derived from? What is the value of a currency derived from? This might be a little economics insight, but it's important because you need to really know the market that you're in. You can't just look at this market and say candlestick, candlestick, candlestick. All that candlesticks show is a movement in time. Yeah, that's all it shows. Candlesticks to show movement in time. We care about the order flow, not the candles. We care about the order flow in the market. Yeah, don't worry about these candlestick patterns. These things, they're irrelevant. I'm gonna show you they're irrelevant. It doesn't matter. Yeah. In saying that, let's give the little economics lesson. So, where does the value of a currency come from? Why do you think interest rates have such a big deal in the foreign currency market? There's two definitions for interest rates. You can look this up as well. So, the first one is the cost of borrowing capital. So, when you take a loan, you pay back interest. That's the cost of borrowing. But the one that we care about is the reward for saving money. So, when you have a savings account, you earn what on it? Interest. Yeah. The forex market is controlled by the interest rate market. When there is changes in the currency's interest rate, you will see a very significant move in that currency pair. Yeah? For example, I'll tell you why. When there's a change in the currency in the interest rate, so let's say there's an increase in the USD interest rate. Yeah? Let's say there's an increase in the dollar's interest rate. The dollar interest rate goes up, that makes the dollar more valuable. Why? Because now if you save dollar, you earn more. The reward for saving the dollar increases. So what should you see on the DXY? A large move up. What's going on in the US economy right now? What's the Fed trying to do? What did they say they're going to do in March? Increase the interest rates. And what we're seeing on the DXY? We're seeing, let's look at it. Move up. That's what we're seeing on the DXY. We're seeing a big move up. Yeah? Nothing is by chance. This market, everything is predetermined. Everything is predetermined. You will see that price goes to certain areas before there's a delivery of news. Why? There's nothing random about it. Now, if you study maths, even at GCSE level, what we're looking at is a chart, right? We're looking at a chart. To understand the chart, right? To understand what's happening in the chart, what are the two things you have to consider of the chart? The axes, right? You have to consider the axes of the chart. So, to understand what's going on the chart, you have to understand the axes. You have to look at the axes. The axes, it tells you exactly what's going on in the chart. Anything. Yeah? So this shows us the relationship between time and price. How many of you thought of that? How many of you thought about the relationship between time and price? That's all that the chart shows. The axes are time and price. It doesn't show anything else. It shows nothing. All this buying pressure, all this selling pressure nonsense. It doesn't show none of that. All it shows is the relationship between time and the price of it. Like any other chart, it shows a relationship between the x-axis and the y-axis. That's all it shows. Yeah. So in saying that, there must be something to do with time and price. They must line up. And that's what the mentorship is going to touch on. We're going to touch on a lot of things, right? And one thing that we're going to touch on is bias. Because once you have the bias, everything else is easy. If you know where price is going, it's very easy to trade. You just have to trade in the direction of the trend, yeah, or the daily close, yeah. So for this lesson, because I want everyone to be on the same level, right? I want you not to understand that the market is run on an algorithm called the price delivery algorithm, yeah. It's run on the price delivery algorithm, and that algorithm seeks to deliver liquidity in the market whilst filling inefficiencies. Yeah. So I'll give you an example. This is an inefficiency. The market, when I mean by inefficiency, it has to offer a fair chance of buying and selling at every price level. That's what a market has to do. A market has to facilitate buying and selling. So this market has to offer a fair chance of buying and selling at every single price level. So this candle, what happened? There's only buying going on here. Yeah. Now, let me just show you something, right? Stay with me. These three candles down, starting from the top of the wick. So this means, yeah, this wick. Why there's a wicket? Because price was up here at one point, and then it sold down, sold down, sold down to this candle. So we know that there was selling from here to here. This candle was buying from here to here, and it was buying from here to here. Yeah. So within this candle, there was at this price, there was selling and buying up until this wick. But this is all only buying was here. The market needs to do what? It needs to balance it out with selling. Yeah. It needs to balance it out with selling. So we need to sell into this price level because the algorithm has to rebalance inefficiencies. Right to the T. There's no randomness in this market. There is nothing random. You'll see that everything is clean. Now, once the inefficiency was rebalanced, what do you see? The algorithm goes and delivers liquidity to these buyers. That's all the market does in a nutshell. The market rebalances inefficiencies. So from here, there was only selling. From here to here, there was selling. Yeah. In this candle, we bought. There was an inefficiency here as well. From here, from this wick to this wick, there was inefficiency as well. But the inefficiency starts from down here. So you can say here to here is an inefficient price action because there's only buying happening. We need selling and buying at the same time because the market has to facilitate a fair chance to everyone to get in the market for all the participants within the market. And what does it do? It goes back to that price level and it allows for selling to happen at that price level. Once it rebalances price there, we see it reacts off of it and boom, delivers liquidity, right? So the outlook for the euro. Remember we had this sent in on the Discord on the chart section of the Discord. So there was a trend line here and we want to see the liquidity taken out. The liquidity got taken out and what did we expect to happen? I want to see price rebalance into this inefficient price action right here. Yeah. If we do get past all of this, then I want to see price deliver into this inefficient price action on the 1 hour time frame. So let's go on the 1 hour. Yeah. So there's only selling happening from here to here. Yeah. Because at the wick, yeah, why is a wick to wick? Okay, I'll tell you why it's wick to wick. Yeah. Because at this wick, when the candle was down here, it went up again. So there was buying. Every single candle has a level of buying and selling. That's why there's wicks. So this candle, it sold all the way down here, and in that same candle, it got bought. There was buys, and it closed here. That's why there's a wick. Yeah. So the wicks show buys and sells. Yeah. So there was no selling from this wick to this wick. So we want to see buying happening in that area. Yeah. So that's gonna conclude the first video. Yeah. And this is a very pinnacle moment for your development, accepting the fact that there's an algorithm at work that delivers price action. There's no buying, there's no selling, there's none of that. There's none of that. Trust me. Buying and selling pressure does not exist in the forex market. Yeah. Doesn't matter how much you're buying, it doesn't matter. The only thing that the market does is it books orders and it delivers liquidity from one side to another side, which is the sell side to the buy side. Yeah. So this is the introductory video of the mental ship. Yeah. And this is, if you want to call it, the start of the rabbit hole. This is how the market actually moves. Yeah. It moves based off liquidity and rebalancing inefficient price action. That's all it does. Now, in saying that, the mentorship is going to go on to explaining when to expect price to deliver liquidity, which side to expect it to deliver liquidity to, and when we should see and expect rebalancing at imbalanced areas. So that's the start of the mentorship. This is video one, introduction. Yeah, I have a syllabus and we're going to go through it. I think it's a smart way to go through the market. But remember, I want you lot to do this, right? Look into something called the interest rate differentials. Look at currencies, yeah? So get the major currencies, yeah? So the USD, the yen, the pound, um, euro, New Zealand dollar, Australian dollar, Canadian dollar, and Swiss franc, yeah? So if you just Google interest rate differentials, yeah? If you Google interest rate differentials, see the relationship between countries that have a high interest rate and a low interest rate. And get the country with the highest interest rate, yeah, out of the major pairs, the highest interest rate against the lowest interest rate. Look at the cross pair and see what's happening in price action. Yeah, so that's all. That's your first study. And any questions, there's a question section on the Discord. Ask whatever you want. Yeah, even if it's silly, it doesn't matter. It's only us here, there's no crowd. Yeah, they say the person who asks a question is only stupid for a minute. The person who never asks a question is stupid forever. So don't be the guy that's going to be stupid forever. Yeah. So till next time. Yeah. Make sure you lot don't trade the pound pairs tomorrow unless there is a good opportunity to do so. Because what do we see? CPI for the pound. And what's happening to the pound? Let me just get rid of these. So what's happened to the pound? It's cleared the buy side liquidity here. It's cleared the sell side liquidity here. It's taken out both sides. When you see that happening, expect a very large move. I wouldn't want to trade this tomorrow. I wouldn't want to touch this. You can see that it's in a dangerous consolidation. It's very whipsaw. It's going up, down, clearing both sides. And it's all engineered for the news launch tomorrow. Tomorrow you'll see explosive moves in the pound pairs across every single pound. So GBP USD, GBP AD, GBP Euro, that's not even a pair, GBP NZD, all those cross pairs with the pound, you'll see in a very explosive move here. So make sure you lot take care of the markets tomorrow. And that's the end of the first video, yeah? Any questions, ask in the question section in the Discord.